The final two topics we have in Chapter 7 are lower of cost or market and ratio analysis. Now, lower of cost or market is important that you understand this is only when preparing the financial statements. So, you're going to use FIFO, you're going to use LIFO, you're going to use weighted average or specific ID, and you're going to come up with your financial statements. And the last thing you do is make sure that when you do your financial statements, you do another step, which is lower of cost or market. So normally we have inventory recorded in the asset account inventory at its cost. And the issue is if we prepare our financial statements and the current value in which a company would be able to buy this inventory is less than what we paid for it. And if this is the case, we have to mark down our inventory account. So again, after we have our financial statements ready to go, ready to be published, we do one final check, one final look at them, and we want to make sure that our inventory isn't overvalued in the balance sheet. Now this inventory value may fall because if we go out today and buy the identical thing, it could have a lower cost, or it may be because it's an outdated or a damaged item. For example, we know that fashion changes. So the thing that's in style one winter may not be in style the next winter. So if we still had merchandise on hand that was from a previous season, it makes sense that if we were to buy that merchandise today, this year, it's no longer in style, we would not pay as much for it. So if we're still showing it on our on our balance sheet at the value at which we purchased it, which is an inflated value, we should really mark it down. We should reduce the value to what we would pay for that item today. And this is called the lower of cost or market, or LCM rule. Now here's an example. We have two items. I don't know why this company only has two items, but let's assume this company has two items in their inventory, leather coats and vintage jeans. The cost of the item is what we would show it at on our balance sheet, and that would be $165 for the leather coat. If today we went out and bought those leather coats, we would pay $150 for them. Since it's now $150, it was $165. We can't continue to show it in our inventory at $165. We have to make it in our inventory at $150. This is the lower of cost or market rule. So we had 1,000 of these. When we did our financial statements, we would have shown $165,000 in inventory for the leather coats. We can't show it at that. We have to show it at the lesser of the current market price, which is $150, or what we paid for at $165. So we have to show it at $150. Therefore, we need to reduce inventory or write down our inventory by $15,000. With the vintage jeans, we paid $20 per item for them. If we go out and buy today, we would be paying $25 per item for them. We cannot mark up to this current cost. We have to keep it at the cost we paid for it. The lower of cost or market for this item is $20, which is what it is showing up for on our balance sheet. It is $20 times 400, or our total cost for that item is $8,000. Since the lower of cost or market rule puts it at the same price as it is already in our balance sheet, we have no write-down at all for this item. So the only write-down we have is for the $15,000 from the leather coats. it's unfortunate that we paid $165 per item for them, when if we bought them today it would be at $150. So a business really doesn't want to have to do something like this, because investors can see it and they're going to say, why did you buy it for $165 when you still have it today and its value would be only $150 if you bought it? So what we need to do in this case is we need to mark down or reduce our inventory. And when we reduce our inventory, the other side of the journal entry is going to be to cost of goods sold. This looks very familiar to you. It's pretty much the same thing as our journal entry under the perpetual inventory method when we are expensing off an asset. The only reason why we're doing this, though, is not to show that the item was sold, but to reduce the inventory value by the $15,000 because it's overvalued in the financial statements. We need to reduce our balance sheet and we need to show it as an expense. So we're going to change our balance sheet and we're going to change our income statement as a result of this analysis. There was a company, and you may have read about this, that had black yoga pants for sale, and they were see-through. They became see-through, and therefore people didn't want them anymore because they were buying them and didn't realize they were see-through. Well, when this company had these items in their inventory, and now the cost of these items, the value at which they could be purchased would plummet because they are see-through, they had to reduce their inventory account. And when they reduced their inventory account, it had a negative effect on the stock market. So the stock price went from here above 80, 82, all the way down to 68, they said. A 17% plunge when they announced this write-down of this inventory. So companies really do not like to have to do this because it says, oops, we made a mistake. Oops, we should not have bought this inventory. We should have waited when its price went down. Or maybe the inventory is not valuable. It's out of style. It is outdated and we shouldn't have this outdated merchandise. We aren't going to make the margins on this merchandise because it's outdated. So investors look at these things and the effect will show up in the financial statements and it shows up in the stock market. The other thing we need to talk about is ratio analysis. And we talk about this because we want to know about our inventory, how quickly we turn it over, and we want to sell it as quickly as possible. And then we also think about it, how many days does it take us to sell our merchandise? And so we're going to do some calculations. They're important for the management to understand what's happening with merchandise. Is it being sold or is it staying on our floors? Because we want to sell it quickly, because the more we sell, the quicker we sell, we are going to get that gross profit, we are going to get cash coming in, and we can use the cash to go out and buy more merchandise, make more gross profit. And so this turning over or churning of inventory is a great thing for us, and it's what we would hope to do. So here we have two ratios that are important. Inventory turnover, and with this we want a high ratio because that means that our inventory is turning over quickly. It's the number of times during a particular accounting period in which the inventory will turn over. So if this were, for example, a year and we had something like 4, it would mean that 4 times during the year we have completely turned over or restocked our inventory because we sold it. And that's a good thing. So returning to that example about fashion, you wouldn't want to have in the summer your winter merchandise still on the floor. So this is particularly important when you're looking at seasonality or items that are sold by a merchandising firm that relate to seasons. Days to sell is the average number of days from purchasing an item to selling an item. Now, a higher number here means it takes a longer time to sell. This is bad. Okay? We don't want to take a long time to sell. We want to take a quicker or a lower time period to sell. And so this number, inventory turnover, we'd like to see it big, and days to sell, we want to see it low. And when we calculate our days to sell, we take 365 divided by the inventory turnover ratio. So to calculate days to sell, you have to use this number in the calculation. It's what goes in here. When we talk about average inventory, what we're going to do for that, where this is coming from, is it's a calculation of beginning and ending inventory divided by 2. Now the ending inventory from your previous accounting period is your beginning inventory for this accounting period. And that's where those numbers come from. We'll work through some exercises and we'll calculate these ratios and you'll understand better what we're talking about.